Hi, welcome back. Now that we've talked about risk and value, let's turn our attention to trading costs. For an obvious reason. As investors, we need to earn higher returns than the market, but those higher returns will be after trading costs. Now you say, how big can trading costs be, especially in a world where we live with online trading and a trade can cost you as little as $6 a piece? I think we might be missing large pieces of what actually goes into trading costs. You're right, some of it is, of course, that brokerage cost, and that cost is decreased over time. But you also have a cost coming from the spread between bid prices and ask prices. In other words, the price at which you can buy an asset and the price at which you can sell the same asset at the same point in time are different. That difference is called the bid-ask spread. The third is, in the process of trading, you can actually affect the price. It's called the price impact. And finally, to the extent that you say, hey, if I waited and broke my trades down, wouldn't the cost be lower? Maybe, but there's an opportunity cost, so waiting. By waiting, you might reduce your returns or not be able to trade at all. So let's take a look at each of those costs, starting with the trading cost track. There's very generic evidence that there is a trading cost track. And as I describe the evidence, you might say, really? We know that money managers trade to get a profit from trading. And if you take the total return that an active money manager makes, that return can be broken down into a return given the risk they take on, plus the return they get from active trading, the choices they bring to the process, the stocks they pick, minus trading costs. Now, we'll talk about disentangling these three pieces much later in this class, but we do know conclusively that the average active money manager underperforms the market by about 1%. And so these average active money managers cut across the spectrum: value, growth, trading, investing. You could argue that that 1% is just a measure of the collective trading costs they face, because you can't make it back because you're talking about something that is pretty much the entire market. There is a pretty substantial trading cost. If that doesn't convince you about the relevance of trading costs, let me give you another sad but true story. One of the most renowned services in the US is a service called Value Line. It's not as widely used anymore, but there's a point in time where if you're a value investor, to learn more about a company, you subscribe to Value Line, and there was a single page on each company, which compressed a surprisingly large amount of data on that page. And Value Line actually was renowned for putting out what were called timeliness ranks on companies. And timeliness 1 were the stocks that they said would go up the most, and timeliness 5, the stocks they felt would go down the most. In fact, one of the biggest sales pitches for Value Line was a graph that showed that over time, their timeliness 1 choices would have vastly outperformed the timeliness 5 stocks. At least on paper, it looked like following Value Line would have made you a very rich person. Now, Value Line must have believed their own hype, because they started a real fund to do what they were telling people to do. In other words, invest in their timeliness 1 stocks. And in this graph, you can see the difference in returns between the returns on paper, the red line, and what their actual fund that was trying to do what they were telling people to do, buy the timeliness 1 stocks, delivered as returns. It's a very average fund. In fact, it got shut down. Saying what accounts for the difference? There's many a slip between the cup and the lip. It's easy to make money on paper, much more difficult to do so in practice. Why? Because execution, transactions costs, and other issues all get into play. So let's talk more about trading costs. Let's start with the bid-ask spread. You go back 30, 40, 50 years. If you wanted to trade a stock, there was a dealer or a market maker on the floor of the exchange who set the spread. You're saying, no, but what goes into that spread? The first is the dealer has to cover the cost of holding inventory of shares that they hold while they're waiting for somebody to buy. So the cost of holding inventory. The second is the cost of processing the orders themselves. Especially in the days before computers, there was a manual processing process that required time and effort. And the third is, if you're a market maker or dealer, you worry about the fact that you might be trading against somebody who has inside information, better information than you do. Inventory, cost of processing orders, cost of trading with more informed investors. Keep that all in mind, because that spread has to be large enough to cover the cost and yield a reasonable profit for the dealer or the market maker. Now, this all leads into the question of why bid-ask spreads vary across companies and sometimes vary across time. If you look at publicly traded stocks, the bid-ask spread you will see on individual stocks varies across stocks. Now, to standardize and compare the spread, you have to divide it by the current price. So if you have a stock that's trading at a $10 price with a bid-ask spread of 50 cents, that's a 5% bid-ask spread. 0.5 divided by the $10. If you have a $1 stock with a 25-cent bid-ask spread, that's a 25% bid-ask spread. If you look at bid-ask spreads standardized across stocks, here are the things that seem to drive the differences across stocks. First is obvious, more liquid stocks. Stocks with a lot more trading on them tend to have lower bid-ask spreads. Second, ownership structure seems to happen. Stocks with a lot of institutional ownership tend to have higher bid-ask spreads than stocks with less institutional ownership, holding all else constant. Riskier stocks tend to have higher bid-ask spreads. As the price level goes up, the spread seems to decrease as a percentage of the price. And to the extent that you have more transparent information about a company or better corporate governance, the bid-ask spreads tend to be larger for companies where information is more opaque or corporate governance less trustworthy. And finally, market microstructure matters. If you have a stock that in the old days used to be off the exchange, you had to go through a dealer, the spreads tend to be larger. Those are all factors driving spreads, but there's a lot of noise in the relationship. So with that in place, let's talk about difference in spread across US stocks. This is from a very old study, and I'm sure that the percentage numbers are varied, the levels have changed, but the overall finding probably hasn't. In this study, broke down stocks based on market cap from smallest to largest and looked at the bid-ask spread as a percentage of the price. First, notice that the average stock price for the smallest companies is much lower than the average stock price for the largest companies, 458 versus 5240. But the bid-ask spread as a percentage of the price is much higher at the smallest companies, 6.55%, as opposed to 0.5%. If you have an investment philosophy that leads you to invest in smaller companies, this has to be part of the calculus. Higher cost through higher bid-ask spreads. Now, if you look deeper at the variation in spreads across US stocks, lower price stocks have substantially higher spreads, something I mentioned earlier. Stocks with higher trading volume have lower spreads. And as insider holdings increase, spreads seem to go up, perhaps because you worry about trading with those insiders. Now, the data on spreads in other equity markets is starting to come in, and for the most part, spreads in other markets, especially emerging markets, tend to be larger than spreads in the US, but the key driver seems to be liquidity. As liquidity has improved in the Chinese and the Indian markets, spreads have decreased, so spreads are on the move as liquidity changes over time. Final point, and this is something that equity investors might view as good news, but we'll talk about how potentially it could be affecting how much you can make as an investor. If you look at spreads over time in the US, it's undeniable that spreads have decreased over time. Sometimes for market microstructure reasons, sometimes because of more liquidity. And this is across the board. Even the smallest stocks in the US have more liquidity and smaller spreads than they used to. Again, a factor in what kind of philosophies might work now as opposed to 30 or 40 years ago. Now, why is the bid-ask spread a factor in investment philosophies? If you have an investment philosophy that leads you to invest in stocks that have disproportionately large bid-ask spreads, you might have great returns on paper, and then once you start investing, you might find much lower returns because the spreads eat away into it. Let me give you a very simple example, one that we're going to come back and talk about more in the context of value investing. But 40 years ago, DeBont and Taylor, Taylor, of course, is a legendary behavioral economist, looked at losing stocks that had lost the most during the course of a year. And they tried out a strategy of buying the biggest losers every year and holding them for the next 2 years, the next 5 years. And they found that the biggest losers, the stocks that had the worst returns in the previous year, tended to be the best stocks to hold over the next 5. Great evidence for contrarian investing, right? But it turned out that the stocks that came in as the biggest loser stocks were often very low price stocks, many trading at less than $1. Putting in a price constraint reduced the returns, and in fact, if you broaden the bid-ask spread that you'd have to pay investing in these stocks, those excess returns start to disappear. We have to be realists as investors. If you have an investment philosophy that leads you away from the largest, most liquid stocks, that's perfectly okay, as long as you're factoring in this particular cost that's going to come with that strategy. Let's look at a second and often related cost. Now, often when you look at a market price, you assume you can buy at that price and sell at that price, even if you brought in the spread. But the process of trading itself can cause a price impact. Why? Because markets might not be completely liquid. You try to buy 100,000 shares in a stock that has only a couple of 100,000 shares traded every day, you will push up the price in the process of buying the shares. You try to sell those same shares, you can push down the price. So one reason is a liquidity effect. And if it's a liquidity effect, it should dissipate, right? After your trading stops over the course of the next day, the next days, next week, it should go away. But there's another reason. You tried to buy 100,000 shares in a stock where there's not that much traded, right? You know the signal you're sending to the rest of the market. He or she must know something I don't. People worry about the information behind your trade. That price impact comes from the fact that if you're more informed and you're buying because good things are going to happen, people are going to push up the price as you try to buy, and that effect is not going to go away. Liquidity and information. Whatever the reasons, though, price impact also can reduce returns. Because if you're investing in companies where you have push up the price as you buy and push down the price as you sell, your actual returns are going to trail the returns you saw on paper. You see, how big can the price impact be? This is again from a very old study. A study that kind of captures a liquidity effect. What the study looked at was big block trades. In those days, block trades came on the floor of the exchange. And what happens if you were able to invest at the time of the block trade? Block trade comes on the floor, there's a price impact, right? It's temporary. If you can buy at that low price and the price recovers quickly, you're going to make an excess return. So this study looked at what you could make as returns from buying after a block trade. And it concluded you could get rich if you could buy almost instantaneously. So if you look at the zero, that is if you can trade instantaneously. And the larger the block, the more money you can make. But here's the downside. You wait 2 minutes, 3 minutes, 5 minutes, your returns are gone. What this study illustrates is how liquid markets are. There's a block trade effect, but it very quickly dissipates. Now, I have to point out that this study looked primarily at large liquid companies. Block trades and much smaller, less liquid stocks might have a longer impact, but the bottom line is a pure liquidity impact is tough to exploit as an investor. Now, if you look at the total trading costs, which includes bid-ask spreads and the price impact, clearly it's much greater for small companies as opposed to large companies. It's much greater for much larger blocks and small blocks. And here is a place where you can start to think about why you as a small investor might sometimes have an advantage over a large investor. As a small investor, you might not have access to some of the special things large investors do, but they have a much bigger price impact than you do. A Fidelity Magellan might not be able to trade on a small company, even if they think it's undervalued, because of the price impact they have, you might be able to do that. So trading costs can cut both ways, depending on small and large investors, depending on the kind of cost. So as you look at your investment philosophy and the strategies that emerge from it, it behooves you to see what types of stocks come in as investments. Are they small, lightly traded companies or large liquid companies? The effect of trading costs are much greater if you have an investment philosophy that requires that you trade quickly. A little later in this class, we're going to talk about trading on information. We often have to trade within a minute of something happening. There your costs are going to be higher because you don't have the luxury of breaking your trades down. And generally speaking, larger portfolios, the price impact effect at least is going to be much larger than with smaller portfolios. One of those strange places where being a small investor can give you an advantage over a large investor. There's a third component to trading costs that we often don't think about, because the reaction that people have when you talk about block trades and price impact is that, hey, why don't I just wait and break my trades down and do it over a period of time? Yeah, you can do that, but there can be a cost to waiting. What is that cost of waiting? One is if you wait, the price might go up while you wait. Let's say you think a stock is undervalued and you decide to buy it over a week rather than right away. Over that week, stocks might rise while you're waiting. It eats away into your returns. In fact, they might rise so much that you might not be able to trade because by the time you get around to doing it, the prices have become too high. So if there is a cost to waiting in some strategies, and if there's a cost to waiting, you can't afford to. You have to take the higher trading costs because you have no choice. So here are the determinants, the cost of waiting. First is what kind of information are you sitting on? If your valuation assessment was based on general public information, you can afford to wait. You think a company is undervalued because you estimated the cash flows, you did an intrinsic valuation. Well, that's what you think. That's not going to affect other people's trades. In contrast, if you think a stock is undervalued, but you think an earnings report is going to come out tomorrow with much better than expected information, you can't afford to sit on that. So first is what kind of information is driving your investment philosophy. Second is how active is the market for information. If you're in a market or you're investing in a company where there are hundreds of analysts tracking the company and tens of thousands of traders, news is going to get out. You got to trade much more quickly. The third is what kind of investment philosophy do you have? If your philosophy is stocks are undervalued and that you're willing to wait for a long period for them to be effective, you can afford to wait. It's not, your opportunity is not going to go away just because you waited 3 days or 5 days. And finally, it turns out that momentum-based strategies have a much greater waiting cost. While in momentum-based strategies, you're buying something that's going up. So if you wait, it continues to go up. It eats away at your returns. Contrarian strategies, waiting might actually make your returns better because while you wait, the stock might continue to move in the wrong direction, at least from your perspective. So you've got bid-ask spreads, higher for small companies, higher for lower price stocks. You've got price impact, much greater for less liquid companies. You've got the cost of waiting, varies across philosophies. Let's talk about trading costs on real assets. Okay. The smallest transactions cost in the real asset sphere tends to be in commodities because they're standardized. Gold, silver, diamonds, iron ore, etc. They come in standardized units. There's no need for an expert to come in and check them. With residential real estate, we know the costs are significant because of the structure of real estate. In the US, you can often end up giving up 5 to 6% of the value of an asset in the process of trading it. There's some pressure on those numbers. They're starting to come down, especially on large real estate transactions, but that's a cost. With fine art or collectibles, the commissions are even higher. Why? Because there are far fewer intermediaries in the process. Right? And also the products are not standardized. You might have a Picasso very different from a different Picasso. So what do? You have to hire an expert. Experts are expensive. So transactions costs are in every investment class, and they're often much greater outside the financial asset class than among financial assets. One final point that I want to talk about in the context of costs that we don't often factor in is taxes. Let me start with an obvious statement. As investors, we get to spend after-tax money, not pre-tax money. So how much difference can taxes make? I have a data set of stock returns going back to 1928, and in this graph, here's what I did. I looked at what $100 invested in 1927 would be worth today, given the compounding effect. $100 invested in 1927 would be worth $983,000 today. It's astonishing, right? But that's because you've been in a very successful equity market for almost a century. You take that same money and you bring in the tax effect. Look at the drop-off. This is assuming that at the end of every year you trade, we'll talk about turnover effects. If you have to sell your stocks and buy them again, you have to pay full taxes, and I've factored in the taxes depending on the year based on what individual tax rates have been in the US. You lose almost 80% of your money. That's more than 80% of your money. That's an astonishing drop-off, right? But let's talk about what it is that drives differences in tax effect across different investment philosophies/strategies. If your investment philosophy leads you to buy stocks which pay high dividends, Historically in the US, the tax rates on dividends and price appreciation have been very different. Price appreciation, capital gains, has been taxed at a lower rate than dividends, and to the extent that the dividend tax rate historically has been higher, an investment strategy, at least in the 20th century, in the US, that was built around high dividend stocks would have paid far more in taxes than an investment strategy that invests in stocks with lower dividends, more price appreciation. The second is, and you can already see this, especially in the context of the previous graph, I assumed you sold all your stocks at the end of every year. The significance of that is your capital gains taxes come due only when you sell. So if you have a longer time horizon, you sell less frequently, you will end up with less of a tax effect than if you trade more, you turn over your stocks more. So what kinds of stocks are you investing? How often do you trade? To show the dividend effect, here's what I did. I looked at, earlier I showed you what happens if you trade at the end of every year and you invest in the average stocks. Here I brought in two other portfolios. One of high dividend paying stocks, which is, and the other is of low dividend paying stocks. So while taxes affect all three portfolios, if you invest in stocks which paid higher dividends than the average stock, you end up with about $90,775. If you invest in lower dividend stocks, you end up with much more. If you invest in non-dividend paying stocks, you'd have made even more. So clearly dividend yields mattered because dividends were taxed at a much higher tax rate than capital gains for the bulk of this period. So the tax effect matters. And if you're an investor in mutual funds, the way this shows up is in the difference between your pre-tax returns and your post-tax returns. And Morningstar over the last decade or so has done a service, has provided a service to investors where they compute the tax drag. The tax drag is the effect on your annual returns from taxes. So in this graph, you see the effect of the tax drag based upon different kinds of investment philosophies. So let's look at all US funds. If your time horizon is 1 year, the tax drag is about 2.5% every year. So if it looks like you're making 11% of your funds, great. But remember, with a 1 year time horizon where you liquidate your funds at the end of every year, you're really making only 8.5%. That tax drag decreases if you have a 5 year or a 10 year time horizon. Longer time horizons, lower tax, but it persists. I also broke, this Morningstar study also broke funds down into large cap, mid cap, and small cap funds. And the tax drag tends to be larger at small cap than large cap funds. It looked at growth versus value funds, and it found that value funds, perhaps because of their focus on high dividend paying stocks, has a bigger tax drag, especially in the long term, than growth funds. But growth funds have a higher tax drag if you have a short time horizon. But the bottom line is tax drags affect returns, and the actual returns you get after taxes captures this. Now, to bring in the turnover effect, I go back to the Morningstar data and I look at pre-tax and after-tax returns for funds, mutual funds, based on turnover ratio. What's a turnover ratio? It's the amount of trading they do relative to the total value of the fund. So if you have a $100 million fund and you have $50 million in trading, your turnover ratio is 50%. So this breaks down funds from really low turnover to really high turnover. There's a tax drag in every single grouping, but the effect, the tax drag effect as a percentage, is much, much greater when you have a lot of turnover. So as an investor, the more frequently you trade and the more frequently your investment philosophy requires to trade, the greater you expose yourself to the tax drag. The bottom line is taxes are a part of life and they affect your after-tax returns. So you have to factor that in and manage taxes no matter what strategy or philosophy you adopt. By doing what? First is, to the extent you can, you want to keep your trading to a minimum. Of course, it's going to vary across different philosophies. Some will require more than others, but the less you trade, the better off you are. Second is, you got to factor in taxes when you're buying. You decide to buy a company because it's undervalued. You might want to look at your tax rate, the kind of company it is. Maybe it's a company with higher dividends, and that tax effect has to factor into whether you buy the company in the first place. You might have to factor in when you sell, because you get taxed only when you sell on your capital gains. You might decide to sell in a year when your tax rate is low. The one piece of advice I would offer you, though, is don't invest purely to avoid taxes. Not only does that put you in legal jeopardy, but historically it's not been a strategy that delivers returns for investors. Overall, if you look at the sum total of what we've talked about in this session, trading costs within the form of bid-ask spreads or price impact or the cost of waiting or taxes, all can cause your after-tax returns to be much lower than what you observed on paper. That's why so many strategies that look good on paper don't look good in practice. I hope you found this session useful, and we will return to this topic over and over again in future sessions. Thank you very much for listening.